Today is Fed Day and the major U.S. stock averages are trading flat. Earlier in the session, we did get weaker than expected inflation figures as well as retail sales. Now we're just waiting for the Fed announcement. So joining me without further ado is Mark Newton of Newton Advisors, and he'll give us an outlook on what to expect going forward. Mark, great to have you here today.
Thank you for having me.
Well, of course, all eyes are on the Fed today, but we need to keep in mind that we've been seeing a rotation as well as a slight recovery in the tech sector following the recent sell-off. But given valuations right now, do you expect to see a trend reversal?
Well, everybody's been saying for a while that valuations are pretty full with regards to the market, but yet the market continues to be resilient. We haven't seen any sign of deterioration. Even the economic data, which has been weaker than expected over the last few months, and bonds have responded. Yields have dropped down to almost the lowest level since last year, but yet stocks continue to ignore all this economic malaise and continue to trade better. So my thinking is that the tech sector is going to be very important to concentrate on. We did see the dip last week. It appears to have recovered, but the sector has been up over almost 20% year to date. So the leading sector, if we start to see some mean reversion, it's going to be important for other sectors to step in to pick up the slack, that being healthcare, industrials, discretionary. And really, we need financials also to stick in there. And if you look at the combination of tech and financials, that's almost 40% of the market. So it's going to be important that if tech starts to pull back any further, the financials really steps in to pick up the slack and do well.
Well, Mark, you are a technical analysis expert, so I do want to ask your opinion about FANG stocks. Given the levels that we saw in the major tech names and the recovery we saw in the previous session, are there any specific levels you're watching for the FANG stocks?
Well, I look at a basket of the group, and it has become quite extended. And so I wrote out to clients last week that I believe we could be in for at least a minor pullback in FANG, given the levels that we're at. They've all gotten extraordinarily overbought. The trends are obviously quite bullish and have been for some time, and there's no questioning that. I think it's going to be difficult for them to sustain this kind of momentum going forward without at least a minor pullback. And we are seasonally in a time of year when we do tend to get corrections. So my thinking is between July and October, we can see potentially 10 to 15% in some of these names, but it would be a good buying opportunity just given the ongoing trends and given that most of them are still very fundamentally sound as well.
Well, Mark, while I have you here, I do want to ask about commodities. Today is Wednesday, so we did get those EIA inventory figures, and we saw a sharp drop in oil prices today, extending losses. But of course, we're also keeping an eye on precious metals, and while we're seeing gold, silver, palladium higher, copper continues to tread lower. So what are you watching in that space right now?
Well, I think looking at crude and gold are both important. Gold has staged a fairly big bounce in the last few months, but we started to see a few signs of stalling out just with the dollar starting to recover a little bit. Now, with the events going on, we saw a little bit of flight to safety and move up in gold, given that inflationary expectations continue to dive. And so with no inflation, if the dollar is going to go down and yields are going to go down, and those are typically bullish times when gold should do well, I tend to be skeptical. I think that the market, actually, the economy is a little bit better than what people are saying. It's not as weak. And so, if anything, yields should start to trend back to the upside, even though we're down near the lower part of the range at 212 on the 10-year. People right now have gotten very, very bullish on treasuries, thinking that yields should continue to extend. Historically, that's been a time from a contrarian perspective to go against that and think that yields rise. So my thinking is we're close to a time when the metals start to turn down. Crude, a lot of it is just based on the demand, along with how quickly can inventory levels start to recede. And we've seen pretty heightened inventories, and the demand is starting to drop off a little bit. So we're still in a seasonally bullish time for crude. I think we probably can hang in there and do okay until the fall. But from the fall period into January, February, historically we've seen crude start to fall down, and I think that's probably going to continue again this year.
Okay, Mark, before I let you go, I do want to get your take on what we have in terms of the calendar coming up. We have the Quadruple Witching at the end of this week, and we have the rebalancing of the Russell at the end of next week. But given that we also have overseas concerns geopolitically, as well as Brexit talks beginning, what are you keeping your eyes on?
Well, I think those are all important, but really none of them have had any bearing as to what the market's doing. I think the key, really starting off this afternoon, is whether Yellen can address the pace of the upcoming hikes and whether those expectations are going to change for how many hikes we're going to have in each year going forward. They had said potentially we could have 3 this year in 2018 and 19. That looks like it could be changing if inflationary data continues to disappoint. The CPA data Earnings, and when you look at economics data, it really hasn't been exceeding expectations as much as we would have hoped, and it's been weaker than expected. So the Fed has a small window to hike. A lot of that's just due to the stock market being resilient. The Fed has become much more Dow dependent than data dependent. If it weren't for the market being at these levels, I don't think the Fed would hike today. And if anything, we could see the rest of the hikes for this year being completely off the table. So you want to look at Treasury yields. You want to look at the 2s-10s curve, inflationary expectations. The dollar is also very important. But for the stock market, financials are going to be the key. That's 15% of the market. It's the second largest sector outside of technology. So going into the fall, if we can see financials hang in there, maybe these other groups can participate like healthcare and industrials and hold the market afloat. I'm hopeful, but part of me says that, all these external events at some point are going to matter. When you look at the geopolitical data and the DC drama, it's going to be tough for the market to be too resilient, and slowly but surely you're seeing fewer and fewer stocks hit new high territory. My thinking is coming into any further rally into July is likely a good time for people to take some profits, take some off the table, and think the market potentially could pull back between July and September, October.
Okay, Mark. Well, there's never a boring market these days given all the political and geopolitical risks. So thank you so much for weighing in on the broader market and for providing your fundamental and technical analysis.
Thanks very much, Remy. Thanks for having me.